Hello, I'm Vadim Poklopkin. Welcome to the chart of the day. The Fed, will they or will they not? The Fed's interest rate decision on July 31st has more hopes and fears riding on it than at any time in recent memory. Wall Street widely expects a rate cut of at least a quarter point, maybe even half a point. Elliott wave patterns in stocks have been bullish, and all three major stock indexes have made new record highs. In fact, the bullish psychology has reached so high now that even bad news is good news for stocks, when even a weak economic number is cheered as a bullish signal, because if the economy is slowing, goes the thinking, the Fed will absolutely have to cut interest rates, which of course is supposed to be even more bullish for stocks. There is another, smaller group of analysts who are cautioning against expecting too much from the Fed. Maybe they won't cut rates at all. After all, the economy is still doing well, so why lower the cost of borrowing? If it ain't broke, don't fix it. So, is there a more objective, more definitive way to forecast what the Fed might do? We believe there is. This is the price of the 30-year US Treasury bond, as published by our July 24th US short-term update, with Elliott wave labels not shown for this story. It shows you the rally in bond prices since last December. By the way, before we go any further, a quick side note. You know how they say stocks and bonds move in the opposite directions? When stocks rally, bond prices fall, and when stocks fall, investors rush into the safety of bonds? Well, if you need any proof that this story is a myth, this chart is exactly that. Stocks, as you know, have also rallied strongly since last December lows. If the conventional wisdom were correct, bond prices would have fallen over the past 6 months, but no, stocks and bonds have trended higher together. And this is not a one-off. Stocks and bonds have been more or less joined at the hip for decades. But back to our question of what the Fed might do at their late July meeting. On these pages, we've shown many times before that the Fed doesn't actually set the tone for interest rates. Instead, it takes cues from the bond market. And because US Treasuries have been climbing, their yields, which move inversely to the prices, have been falling. In other words, as bond prices have been rising, interest rates have been falling. That's why our July 24th US short-term update also said this. The spread between the yield on short-term US T-bills and Fed funds is widening, indicating that the Fed will lower interest rates next week to align with the market. You might say that this conclusion is in line with Wall Street expectations. And that's true. But while most conventional analysts are looking outside the market, at factors like unemployment, consumer confidence, and other fundamentals, the simplest and arguably most assured way to know the Fed's next move is right here on price charts. You just have to know where to look. Right now, our analysts are also keeping a close eye on the Elliott wave price pattern in US stocks. The pattern that's been in place since late April has been unfolding in a remarkably textbook manner. Investors who want to know what stocks will likely do after the Fed meeting, and regardless of its outcome, would be well served to keep an eye on the message Elliott waves are sending right now.